5 months ago, I did something that was pretty scary. I took £20,000 of my hard-earned savings, the biggest lump sum I've ever had in one place, and I put it all into the stock market in a single click. Now, you might expect me to say I lost a chunk of it, or maybe you think I found some magic secret to get rich. Well, I've checked the app and the results are here. If you're sitting there with some savings, wondering if you should be doing more with it, but you're scared of making a mistake, I get it. In this video, I'm going to show you exactly what I invested that £20,000 in, why I chose it over keeping it safe in the bank, and I'm going to share the exact value of that pot today. But first, know that I'm not a financial advisor and this is not financial advice. Your money is at risk when you invest. Okay, so if I think back, why did I take this decision in the first place? I had £20,000 just sitting there and I was trying to come up with a foolproof investing strategy that, importantly, I was going to be able to get behind and stick with and not have any reservations or feelings of uncertainty. And I was reading the book Happy Sexy Millionaire by Stephen Bartlett. Now, I didn't buy into everything that he was saying in that book, but something that really did stick with me is the section where he talks about money and building wealth. He mentions that Einstein referenced compound interest as the 8th wonder of the world. And it is a pretty compelling argument to say that you need patience, you need a long-term view, and you need to be able to delay gratification to make wealth. And I think it's the most accessible and easiest way to do that through the stock market and investing. To cut a long story short, the maths make sense when you look at historical performance, which obviously is not a guarantee of future results. But when you look at that, you can see quite feasibly that over 30 years, you can 10x your money. And if I left that money in cash, inflation would slowly eat it away. I realised that by playing it safe, I was actually guaranteeing that my money would lose value. And so I decided that for my situation, the real risk came from doing nothing rather than from investing. But knowing why is the easy part, and the hard part, the bit I think that stops most people, is actually knowing what to buy. So let's talk about that part next. And I actually do have, when I was preparing for this investment, I had a checklist of sorts that I knew I wanted the fund to meet. I also put together a list of 10 plus different funds that checked most of the boxes, and I've put that in the description of this video in case you want a little bit more variety for options and to get you started on your own research. I wouldn't recommend that you just jump in and do what I'm doing because I don't personally know your situation, and so I would always recommend that you research through these yourself. That said, the one that I went with is the ACWI ETF. And there's a really important and useful document that is always available when you're looking to invest in an individual fund or ETF or basically anything on the stock market. It details some key points which we can run through, but included is the investment objective. Now, if I read this off, the objective of the ACWI ETF, which I put my £20,000 in, is that the fund seeks to track the performance of stock markets in developed and emerging market countries. That is quite significant because there are some funds where it's only going to be tracking developed countries, not emerging markets. I wanted to incorporate it all because I wanted it to be as diverse as possible. That's something that you will have to choose whether you want to do yourself. But think of it this way. Instead of trying to find the needle in the haystack, I just bought the entire haystack. I effectively now own a tiny piece of over 2,000 of the biggest companies across the entire globe by buying into this specific fund. If we keep looking at the information on that key investor document, you can see the risk and reward profile where it sits on the higher end of the spectrum at actually 6 out of 7. And this is actually based on the historical performance data. So really, when you look at this, you can see that it is highly volatile, as in the value goes up and down a lot and quite aggressively. And in any one year, you can see that it could be up or down by as much as 20-25%. And this is why it is cited as being high risk. The only charge that I'm going to have to worry about on this particular fund is the 0.12% ongoing charge, which means that it will cost £12 per year to have £10,000 invested for buying into all of these different companies. And this is the only fee that I have to worry about because of my platform choice. So obviously you've got the fund and the platform. Those are kind of like two big decisions that might be a little bit tricky for first-time investors, but I invested this money through Trading 212, and they don't charge any platform fees whatsoever for using their stocks and shares ISA. The currency was also default to Great British Pound, so there's no conversion currency fees or anything like that to factor in. Now, why did I choose Trading 212? There's a few different reasons. It's not that it's my default platform of choice. I actually use a number of different platforms, and there are many platforms that I like. Trading 212 specifically had my cash already, and they have a very useful feature, which is a flexible ISA feature. Now, because this money was originally safe, being held as cash on my account, I had the option to invest that money without withdrawing it and losing my ISA allowance for that tax year. And so I took the decision to invest with Trading 212. And obviously Trading 212 is a good platform in its own right. And even though I hadn't used them to invest through before, I really did want to try and see how I found the platform, because part of this bigger decision to invest and commit to a fund is that longer term I want to consolidate my investments from other platforms into one sort of master platform, master investing strategy portfolio. So with all that going on, and my situation is more complex, if you're coming in from scratch, you can obviously choose whichever one you like. But for me, it just made logical sense to keep that money there because I didn't want to lose my ISA allowance, and also I wanted to try out the platform. With all that said, you want to know, how much is that money worth today? Well, back in July, I invested £20,135, and 5 months later, that pot is now worth £22,373. That's an unrealised return of £2,238, or over 10%. If this carried on for a whole year, it would be an annualised return of 27.2%. And to put that into some perspective, my savings account was paying about 4% a year. So I've made more than double that in less than half the time. So I should be celebrating, right? And maybe I should be telling you all to just dump your cash into this fund immediately. Well, I don't actually think that would be a good idea, and here's why. Making 10% in 5 months is great and all, but I need to be brutally honest with you. It was luck. Remember that risk profile. It was a 6 out of 7. That means this investment is volatile, it goes up and down violently, and I didn't invest this money for a quick win anyway. If the market had gone the other way, I could have just as easily lost £2,000 in 5 months. And if that had happened, would I have panicked and sold out? No, because my plan was never about 5 months. It's about 30 years, or at least 5 years. I have no interest in settling for an easy 10% profit now, when the math says I could be 10x the amount if I just leave it alone for a few decades. The market has been kind to me since July. It might be cruel to me in January, and that is okay. So do I have any regrets? One is that I didn't invest this money sooner. I was getting daily interest, which is why I think I had delayed investing in the first place. But in the end, it was way more logical and easy for me to just invest the money. My plan now is boring. I'm going to do absolutely nothing. I'm going to let that money sit there, ride the ups and the downs, and let compound interest do its thing. If you are watching this and thinking, that's great, but I don't have £20,000 to drop at once, how do I actually start small? Then I have a new video focusing on my £100 investment that would be great for you. If it's not live yet, you'll see YouTube's recommendation over here. Thanks again for watching, and I'll see you in the next one.